Welcome back to Investing with Mackie, where we demystify the world of trading through data visualization. Today, we're diving into one of the most important concepts in option trading, the Greeks. Today, we're looking at one of those concepts called delta. Options can be complex, but understanding the Greeks can make it much easier. These are measures that help traders evaluate risk and potential rewards. They also help us to better understand option pricing. Here in this chart, we can see option prices for SPY over time. Each line represents a single strike price, and lines that are displayed in this chart as of now include prices that are above and below by 5% from the current strike price. So we can see the data was pulled at 9:35 today, and the current price at that time was 474 for SPY. If you want to interact with this chart, I have a link below, but it's priceprobability.com. The Greek we're looking at today is delta. Simply put, and easily found if you Google delta on any finance page, says that delta measures how much an option's price is expected to change for a $1 change in the price of the underlying asset. For call options, we can see some deltas for those here. Deltas range from 0 up to 1. For put options, it's 0 down to -1. This number tells you the sensitivity of the option price to the stock or underlying price movement. For example, a call option with a delta of 0.5 will theoretically increase by 50 cents if the stock goes up by $1. Conversely, with a put option, if the delta is -0.5, the price would theoretically decrease by 50 cents if the stock increased by $1. Delta isn't static, and it changes as the market moves and expiration approaches. This concept is known as delta drift. In this chart, we can see how delta changes over time and across strike prices. As expiration approaches, the delta for calls will move towards 1 for in-the-money options and down towards 0 for out of the money. This can be seen as we look at the data here with lower strike prices or more in-the-money options at the top near 1. Let's see, 450 right down to 475 at the bottom. And then at the bottom, as pointed out, we have delta going towards 0 for our out-of-the-money options. Understanding delta is key for traders. It helps in making predictions about price movements, in hedging, and determining the likelihood of options ending in the money. So to quickly review, delta is a measure of an option's price sensitivity to the underlying asset's price. Ranges are from 0 to 1 for calls, 0 to -1 for puts, as puts pricing moves opposite the underlying. Lastly, delta can be used as a tool for predicting price changes and managing risk. And that's delta. For more insight into option trading and the financial markets, make sure to subscribe to our channel. Drop your questions in the comments below and let us know what topic you would like us to cover next.